Hi, good morning. Welcome everyone to our latest installment of the Borak series. I may have skipped one, but I'm back. For today's episode, I thought that we should give our investors some flavor on what is going on to our local economy, given that markets have been so tied up with economic data recently. Here to help us today, we have our Chief Economist, Suhaimi Ilias. Welcome to the show, Suhaimi.
Thank you, Naguib. Good morning, everyone.
Morning, Suhaimi. Alamak, macam tak minum kopi lagi ni. Well, anyway. Yeah. So Suhaimi, I understand you wrote a piece last week, basically outlining the intricacies of Malaysia's first quarter 2023 GDP announcement. Also, I think the announcement from Bank Negara on OPR, which actually caught market off guard, I guess generally majority of the market. I've read through it, and my goodness, there are a lot of facts to cover in there. So for the benefit of the audience, could you just go through some of the key points, key highlights from our GDP announcement last week?
Yeah, Naguib. I'll start off with a whole bunch of numbers here, just to put the performance of the first quarter GDP growth in context. I think obviously GDP growth in the first 3 months of this year moderated to 5.6% year-on-year from 7.1% in the fourth quarter of last year, although still better than 4.8% year-on-year growth in the first quarter of 2022. Last quarter's growth was actually in line with our estimate of 5.7% year-on-year, but came in better than a consensus estimate of 4.8%. It was driven by slower growth in all economic sectors, as well as deceleration in consumer spending and private investment, coupled with a somewhat flattish public expenditure. But overall, I think the first quarter 2023 growth indicates official growth forecast of 4% to 5% this year is achievable, on track. And on our part, we actually revised upwards our full year GDP growth forecast to 4.5% from 4%.
Okay, well, that's good to see that even though, we feel that there were some signs of, I guess, a kind of a slowdown, so to speak, we're still growing and on track to hit our GDP target of the year. So diving a bit deeper into the report, you mentioned something about our country's sector performance. Could you give some insight into that as well?
Well, Naguib, all economic sectors, services, manufacturing, agriculture, mining, construction, posted slower growth in first quarter of this year compared with fourth quarter of last year. But services and construction grew the fastest among the economic sectors. I think they're running in excess of 7% as they benefited from economic reopening, from tourism recovery, as well as resumption and progress in major infrastructure projects. In the case of manufacturing, agriculture, and mining, unfortunately, they expanded at a much slower pace, I think between 1% and 3%. This is due to the global economic slowdown affecting especially our export-based manufacturing industries, as well as impacting the prices of our major commodities, oil, gas, CPO, crude palm oil.
Sure. But okay, so let me take a step back. So construction and services, I guess it's probably where we would see some, I guess, excitement, and I think that should be. I think we're going to communicate this to to our audience. But would you think that this is sustainable for the year? I mean, or maybe the ones who are lagging would probably be the sectors that we'll be looking at. I mean, I know it's only the first quarter GDP. But I mean, generally, what your gut feel would say?
I think basically the services sector in particular will outperform the rest of the sectors in the economy because of the continued tailwinds from full economic opening, particularly those that are tourism and travel related, like F&B, accommodation, aviation, sectors like that. Construction, of course, were disrupted during the pandemic years due to lockdowns. But I think with the economic opening together with this resolution over the issues of shortage of foreign workers, they will also be benefiting from those factors. Hence, our view that in terms of relative growth performance, services and construction are the sectors that would outperform compared with manufacturing and those agriculture and mining that are commodity related.
Okay, well, that's good. I mean, that's quite clear. Maybe I'll just remind investors that we also have our, basically our recommendations from Anand Patmukantan to our top buys and all that. So maybe if you have any questions, probably just go ahead and speak to our sales force and they'll get back to you on that particular report. So I think, well, that's clear on, we've got the big picture, then we've got our, I guess, sectors. So I think one last question before we sign off today. At the beginning, you mentioned that we're revising our GDP estimates upwards to 4.5% this year. So, I mean, I guess there was some concern in the beginning, but I just want to, again, ask you any specific reason for that, and I guess what are the, what's the thesis behind that?
Well, Najib, a bit of background on our original full-year GDP growth forecast of 4% made late last year. That was based, among others, on our assumption of first quarter 2023 GDP coming in at around 5% year-on-year. But as mentioned, the actual first quarter 2023 GDP growth numbers was better at 5.6%, in line with our updated estimate of 5.7%. Because obviously we make use of actual economic indicators like industrial production, index of services, crude palm oil output, value of construction works done in the month of January, February, and March. These are key ingredients in the recipe to calculate or estimate GDP. So with those actual numbers came in, we revised upward full-year growth to 4.5% by factoring in the first quarter actual performance of the economy. Bear in mind, this is still a slowdown from last year's 8.7% growth that was boosted by full economic opening. The outlook also reflects high base effect, especially second quarter and third quarter last year. Economic growth surged to almost 9% year-on-year and 14% year-on-year respectively, as economy rebounded strongly with full economic opening since April last year. That's the kind of number that's not going to be repeated in second quarter and third quarter of this year. Of course, we have to bear in mind also there are impact of higher inflation, higher interest rate on domestic demand, as well as global economic downturn on our exports. But also important, I guess, for me to highlight, limiting the slides in economic growth this year include drawdown of household or individual excess savings that were built during the pandemic years due to lockdowns, as well as stimulus measures like EPF withdrawals and various cash and financial assistance plus tourism recovery will act as buffers to consumer spending. We also have positive investment growth momentum, aside from, as I mentioned earlier, the resumption and progress in major infrastructure projects. We also have this surge in approved private sector investment since 2021, all the way up to latest figure for first quarter of 2023. And this is translating into rising actual or realized private investment. And last but not least, with China exiting its zero COVID-19 policy and adopting full economic opening, we expect faster growth in China to mitigate or offset the downturns in US and Europe.
Okay, great. So I hope our audience find some comfort, because I think generally I think that there was a little bit of concern, especially coming into the second quarter. But again, that's all the questions we have for you today. Thanks, Suhaimi. Great stuff as usual. Again, I think the most important thing here, would there be, I guess one or two key points that you just want to remind the audience with regards to, I mean, staying on course for the year with regards to our economic data?
Yeah, I mean, as mentioned earlier, I guess economic growth is moderating, but the keyword is moderating. We are not looking at recession scenario, even if there are concerns about potential recession in major advanced economies, but I think China opening will provide some buffers to that. Maybe the other thing to keep an eye on, I suppose, is Bank Negara's monetary policy. They have raised interest rates earlier this month. Our interest rate is back to pre-COVID level of 3%, and my take is that's it. Bank Negara is done in terms of normalizing its
one and done,
interest rate policy. Yeah,
it's one and done. All right. Okay, it's a wrap for it today. Just thank you again, Suhaimi. Thank you again for sharing this with our audience. So I think we'll speak again, and till then, thank you very much. So
thanks, Najib.
Thanks, Suhaimi. So all right then, to our audience, you can get the latest market news and research from our social media channels. Our content is available on Telegram, LinkedIn, and YouTube. Alternatively, if you're interested to find out how you can trade with Maybank, you can also reach out to our digital team or our sales team to find out more about our services. If you enjoyed today's copy session, do consider dropping us a like or even subscribing, and we'll see you next time. Till then, this is Naguib signing off. Thanks, everyone.
Do 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 do.